Live from New York City this morning. Good morning, good morning. We have a little bit of a rally with equities up by 1.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, the strength of the U.S. consumer.
The consumer has really been the heart of this economy.
The consumer remains strong.
Consumers are spending.
We still have that $2.5 trillion of excess savings.
We're seeing credit card spending going up. We're seeing the loan pipeline at banks continue to do well.
I am concerned about how resilient they can be. There's the idea of looking at what the data is showing right now versus trying to think about the different range of outcomes.
Real income is down deep into negative territory.
Inflation is 8+%.
Wages are not rising as much as inflation.
Mortgage rates going up quite dramatically.
Energy prices rising, agricultural prices rising.
A slew of consumer goods are going up and staying up in prices.
You have to expect that the consumer is going to pull back somewhat here.
Great lineup this morning. It begins with Deutsche's Deepak Puri. Deepak, let's start right here. Just how resilient is the U.S. consumer in the face of everything we're talking about through this year?
Good morning, John. Yes, indeed, this morning's retail sales number gives you a little bit of a snapshot of how resilient the consumers are. But again, I wouldn't read too much into it. It's not inflation adjusted. Let's keep that in our minds. And I think the trickier numbers on the consumer side are in front of us rather than behind us.
Deepak, with that in mind, when you look at the earnings this morning from both Home Depot and Walmart, who do you think tells the story that you're looking to develop just a little bit further through the year ahead? I look at the numbers from Walmart, and the CEO said the following: U.S. inflation levels, particularly in food and fuel, created more pressure on margin mix and operating costs than we expected. Is it a Walmart world for you or a Home Depot world?
Well, it's a little bit of both, right? U.S. consumers comes in a variety of different demographic groups and different spending patterns. But I think it's a good snapshot of where different companies are going to see and how they're going to navigate this kind of consumption change. I do believe that there's going to be a shift that's going to be taking place in the upcoming months and quarters as we get closer to and get used to tighter monetary conditions, cost of capital going up. And let's be honest, the disposable personal income numbers, which look quite healthy for now, once you start factoring in higher cost of gasoline, food, which might stay sticky for a longer period of time, that disposable income might see a downtrend. And last but not the least, the Fed would really like to see some of the tightness in the labor markets to go away. So the idea would be to, the wage inflation to slow down a bit, and I think that would have an impact on the overall spending pattern.
27 minutes out from the opening bow, futures are positive by 1.5% on the S&P, on the Nasdaq by 1.9%. The retail sales data pretty good. Taking a look, here's Mike McKee. Morning, Mike.
Good morning, John. Yeah, pretty good. Perhaps a little bit better than expected, even though some of the categories didn't come in as high as economists had thought. But retail sales up 1.4% in March, up 0.9%. It's the control group we watch, and it's up 1% during the month, which is just barely changed from 1.1% in March. So Americans are still spending some money, and you can see there gas stations were a real surprise, down 2.7% after rising 9.6%. But look at department stores, up 1.1% after a flat reading in March. The weird thing is people thought that we'd be spending so much more on gas, we wouldn't be able to spend on other things. Motor vehicles making a big turnaround there as well, and that added a lot to these nominal numbers. The big question is, will gasoline prices and food prices crater spending going forward? We've seen some major changes in both of those over the past year, where we're up like in the 30%, 37, 32% for gasoline. Food prices up 10% over the year, and that is making a big difference in terms of how much you've got left over to spend. But so far, people seem able to spend. Question John asked me earlier today was, what does this mean for the Fed? You don't have to ask me. We can ask the Fed. There's 6 of them speaking today. Jim Bullard, the first out of the gate this morning, saying he thought that personal spending would hold up because they were going to have strong labor markets that would give people additional wages. The man of the hour, or the man of the day, is going to be Jay Powell, speaking a little bit later at a Wall Street Journal conference, and Wall Street will be paying a lot of attention to him as well as everyone else on the open market.
Mike, what's left to say? What is left to say, given everything we've already heard from this group?
Probably nothing. If you're trading today based on the retail sales figures, maybe you want confirmation that you read it right. But at this point, we know the Fed's going to go 50 in June, 50 in July. So the economic data are either going to need to surprise a lot, or we're going to have to wait until the July data start to come in before we see a change in Fed policy.
Mike McKee, looking forward to the Fed speak a little bit later. Some people are, at least. Mike, thank you. Tom Kennedy at JPMorgan joins us now. Tom, great to have you with us on the programme. I want to get your response to the data we had about 35 minutes ago, and we'll work our way through it from there.
Yeah, good morning, John. The data is, I think, what Deepak said. This is something we can't latch on to in aggregate right now. It is a strong consumer. We already knew that. Tons of revisions in these data, and that post-COVID experience of data revisions just continues, which makes it challenging to read it in the moment. Circling back to what Michael said, which is waiting, and what Deepak said, which is financial conditions have tightened. This has been the most historic tightening in financial conditions we've seen, absent a recession, going back 30 years. And it's just going to take time to see it filter through. I think this is the question the Fed, John, is going to be asking themselves. Have conditions tightened enough to slow growth and inflation? We're already seeing growth and inflation numbers for 2023 from Wall Street start to come down. And in June, we should see the same from the Fed.
Tom, the starting point for a lot of people is how resilient is the US consumer, how strong are household balance sheets, and with that in mind, how high do rates need to go to curtail demand? How do you work your way through that 3-step process?
Yeah, the biggest debate on Wall Street is how high do rates need to go to slow growth and inflation. First of all, John, the resiliency of the consumer is not necessarily the most important question in there. It's what is the behavioral response to average Americans when financial conditions tighten. Academically speaking, in the bond market, every rate you look at says cash rates will be above 2.75% for the next decade. John, my son is 6 years old. He'll be driving in 10 years. I'm not that confident cash rates will be that high. And to bring it back to home, we're already feeling the consequences of a very tight monetary policy. 30-year mortgage rates, 5.5 is the most rapid rise in that rate, and relative to existing mortgages today is consistent with a disincentivized to prepay, a disincentivized to move. The most cyclically sensitive sector of America should start to slow meaningfully in the coming 3 to 6 months.
And Tom, given the price of the story, you sound like a man that's becoming a little bit more constructive on risk assets. Is that a fair characterization of your current viewpoint on things?
This tightening in conditions, John, was necessary for a soft landing. So the soft landing possibility is still our base case. And really, we're questioning more about have conditions tightened too much here. I know the going narrative is that there's no way the Fed is behind the curve, but there's a meaningful tightening in conditions so far. For me, it starts to lead to investors should be adding core, boring, liquid fixed income to their portfolio. They're underweight. And if we get a soft landing, yields should come down. And in the unfortunate event we get a recession, those yields should come down a lot.
Deepak, Tom Kennedy thinks bonds are back. Just pure, boring treasury bonds. Do you agree?
Mostly, for sure, they are better buy today than they have ever been in the last few years. Listen, we are coming from an era of financial repression. You're buying bonds at a very high price with low interest rates. And if you were holding bonds to maturity, you were going to lose money. So those losses are not going to be going in the forward. You're not going to see those kind of losses. And obviously, parts of the bond market looks quite interesting. The municipal bond market for us, for our private clients, look quite appealing, especially if you're looking in a high state, tax bracket. And I think there are other parts of the fixed income markets that are starting to come back. I would not really shun any one particular asset class. So, there are parts like from the credit. We'll probably take a little bit more credit risk than duration risk, given where the yields are, and don't fight the Fed, as the saying goes, even on the rate side. So I think risky assets in particular are making a comeback. I don't want to discount the fact that we have had 6 weekly losses in the S&P 500. So I think the gut reaction is to find comfort in some, plain vanilla bond portfolios. My take would be to still be a little bit more conducive to risky assets. That's, long duration asset plays given on the equity side. So, when we look at our asset allocation, I think we are a little bit more biased towards equity markets.
Deepak, biased towards the US equity markets, biased towards big tech. Just go through it with a little bit more color.
Sure. So the first thing is to avoid certain things, and those would be 3 categories. Those are the ones that really did well, during the pandemic era. So avoid the pandemic winners, avoid the ones with no growth, or, companies that had the luxury of really free cost of capital without really having a post-COVID business plan. And then maybe also the big, when we were in the pandemic, the bigger the company was, it gives people comfort, investors some sort of a comfort that big is better. And I think now you should start leveraging a little bit towards the other side of this markets, whereby, a bit more cyclicals. So here, energy, industrials, materials would come into play. Long duration, real assets, so infrastructure might make sense for certain investors. REITs have tended to do better. So those kind of the investments would do well. If you really have a base case as a recession, then defensive should start making their way into the portfolio. Here, healthcare would be right at the top, along with some consumer staples names. So I think you need to measure what you're currently invested in. Yeah. Try to see if some of those names still give you that comfort. Most likely not if you've been sticking with them for quite some time, and start gravitating towards some of the names that can either potentially hedge you against a rising inflation and elevated inflation level, or protect you if there was a downward recession, which again is not our base case scenario either.
Deepak mentioned the 6 weeks of losses we've had in the equity market. Something changed in the bond market. We had 5 weeks of Treasury yield gains until last week. We snapped that streak. Yields headed lower. We kissed 320 2 Mondays ago on a 10-year. Right now on a 10-year, 296, up about 7 basis points. Tom Kennedy, that negative correlation that we seem to have re-established with the equity bond story, do you think that sticks, and why?
No, I don't think it does, John. What's the prerequisite to make, really, you're describing the environment where the 60-40 just simply doesn't work. Both legs of it are hurting you. If you look back over the last 15 years, there have been other instances and periods where this happens. It is in big monetary policy inflection points, namely 2013. This one feels especially painful because it's happened so quickly. But it circles back to that original question. When are rates high enough that the Fed has the optionality and the balance in the economic outlook and hitting their mandates? We think they're there. So the 60-40 should reestablish itself, and that inverse correlation should work. The scenario, John, where that's wrong is that the growth and inflation numbers for next year just don't come down. And the average American is not as interest rate sensitive as we like. It's a possibility, but I think that's, of the scenarios we're talking to here, it's the lowest scenario relative to just an outright recession or a soft landing.
Thomas Kennedy, Deepak Puri sticking with us. Yields are higher through the curve, up 9 basis points on a 2-year to 266. Up about 8 basis points on a 10-year to 295, 296. That is the price action in the bond market. Let's get you some moves about 15, 17 minutes away from the opening bell. Here's Abby.
John, let's start out with a tale of 2 stories in retail. Of course, I'm talking about Walmart and Home Depot. Walmart is falling sharply lower. In fact, heading to its worst day since March of 2020, rising costs taking a toll. They missed earnings estimates for their fiscal first quarter by 12%, despite a sales beat. They've also cut the profit forecast as a result. The inflationary pressures really coming in on need to have food and fuel. For the nice-to-have home improvement retail sector, however, Home Depot, they beat earnings by 10%, sales by 5.6%. They've boosted the full-year forecast. So even despite rising mortgages, it seems folks are out there buying items to improve their homes and other necessities that they can get at Home Depot. As for Citigroup, up 4.9%. Berkshire Hathaway has revealed a 2.9% stake, really bought at a discount, the stock near an 18-month low. And then as for the engine behind the big rebound for stock futures this morning, big tech, Apple up 1.8%. Even with yields higher, it seems as though the sentiment is improved, maybe having something to do with the positive Asian session. And of course, Europe is higher too, John.
Abby, thank you. Coming up on the program, why for many, cash is king.
I do believe stagflation, unfortunately, is the baseline. We're going to see notably lower growth, and we're going to see frustratingly high inflation.
Coming up, the Bank of America Fund Manager Survey. That's next.
I do believe stagflation, unfortunately, is the baseline. We're going to see notably lower growth, and we're going to see frustratingly high inflation for this year and into next year. Whether we get something worse depends on the soft landing debate for the Fed. I do think that the left tail of recession is something that we must keep an eye on.
Investors piling into cash amid mounting stagflation fears. That's the headline from Bank of America's latest fund manager survey, writing the following. Bottom line, extremely bearish May survey, but missing full capitulation. This is the piece that investors need to look for, apparently. We're expecting rate hikes still and not cuts. And Michael Harnett and the team say stocks are prone to an imminent bear rally, but ultimate lows haven't been reached. Kaylee Lyons has more. Hey, Kaylee.
Hey, John, that doesn't sound absolutely fabulous. Yes, no capitulation yet, but still an extremely bearish survey, evidenced by the fact, as you alluded to, investors are flocking to cash in a way we haven't seen in more than 2 decades. Cash piles, according to this May survey, at the highest level since 9/11. And growth optimism is at a record low. Stagflation fears at the highest since 2008. That really is your reason why. A lot of that stemming from what investors see as the biggest tail risk out there, and that is hawkish central banks, followed shortly thereafter by a global recession, with which both now top concerns over inflation and the war in Ukraine, which have come down a bit. Systemic credit events also coming in down at number 5. And as for what all of that means for allocation, as I said, cash the highest in September of 2001, positioning overall the most defensive since 2020, including the biggest equity underweight since that year and the largest underweighting of technology in particular since 2006. As for where investors are long, healthcare, staples, and commodities, and long commodities actually tops the list of most crowded trades. Then short treasuries. You also have long tech, long Bitcoin, long ESG in there. And again, coming back to that cash issue, John, long cash coming in at number 7.
Some of these numbers just remarkable. Katie, thank you. I know you and I both read this thing when it comes out every single month. It came out earlier this morning. I'll go through those lines again that Katie just went through. Highest cash levels since 9/11. Growth optimism at a record low. The biggest equity underweight since 2020. Tom Kennedy, Deepak Puri back with us. Deepak, this is the view of B of A, that we're missing this final piece of full capitulation because investors still expect rate hikes and not rate cuts. What do you make of that?
Yeah, this is interesting, but I'm not too surprised. When you look at least from my experience, right now, investors are sort of numb. They don't know what to make of all these idiosyncratic risks originating from outside of the U.S., where you don't really have much control over. Even the Fed has said that they don't really have much control over those items. So I think rather than the surveys gives you a good soft insight, but the actions are a little bit more that of a wait and watch scenario, and that's really, at least on the risky side, that I continue to see. Not surprising, people are taking refuge in cash. Cash tends to become a way more important of an asset class when you really don't feel the compulsion or the appeal in any other particular part of the market. Having said that, I think on a tactical basis it might make sense, but on a strategic long-term basis, obviously it's not really where you want to be given where the inflation numbers are and the fact that you're going to be losing your purchasing power. So overall, there are other things investors can do, should do to protect themselves. I think to get go, you got to have some time in the markets, but you want to stay invested, maybe make some changes within the rotation, within the sectors and industry that you want to stay invested in, but don't really shun investing in equity markets in particular. You've talked about this. You guys have been talking about it all morning. You know, when you have drawdowns on the fixed income markets, very difficult to get back to make unrealized losses become realized gains. But on the equity market side, that can happen. And normally, the best days tends to happen right along the worst days. I'm not a big bull. I'm not slamming on the desk and saying it's a great bull market.
Yeah.
But on the other hand, I would say that I think the peak pessimism in almost everything is right here, right now. And going forward, you should start seeing some green shoots developing in a whole host of areas.
It's on final word. Can you call it peak pessimism when 2s 10s are still at 30 basis points?
You know, John, I never try to call the peak on that.
Go on, Tom.
I just want to layer on to what Deepak's saying there. Cash levels on our platform as well, John, near historic highs. This is in times of uncertainty where people are seeking refuge, and when the 60-40 is not working, that certainly makes logical sense. What's different from the Bank of America survey relative to our platform is this is not the most underweight equities we've seen our clients. So trying to find some insurance benefits of core bonds is where we're focusing to try to add some clarity and some portfolio insulation in a time of high uncertainty.
Deepak, I've got 30 seconds. I know you want it. You can have it.
Yes. So, you know, one thing I'm really following, you look at the 10-year inflation expectation. They've gone down from 3% to 2.7% today. We might be at the end of this inflation peak, and I'm talking longer-term inflation expectations. And I think that is telling the markets, at least to myself, that whatever the Fed is doing, it is starting to work. So I would just tell the investors to hang in there and start looking for some good news in the months and quarters to come.
Deepak Puri, you'll be back before then. Thank you for being with us today. Tom Kennedy, to you as well. Your opening bell is 7 minutes away. This is Bloomberg. Equity markets are higher. Here are your morning calls. Your first one, Piper Sandler upgrading AMD to overweight, highlighting upcoming catalysts as the chipmakers' core businesses continue running smoothly. Bernstein downgrading Molson Coors to market perform, seeing little remaining upside with Europe's recovery now largely priced in. And finally, Wedbush reiterating its bullish stance and $1,400 price target on Tesla. This as Elon Musk injects even more uncertainty into his complicated Twitter takeover. Up next, Wedbush's Dan Ives, just around the corner. "24 seconds away from the opening bell this morning. Good morning to you. Your equity market pushing higher on the S&P by 1.6%, on the Nasdaq 100 by about 2 percentage points, on a Russell by 1.85. A nice lift and a ton of earnings we can talk about in just a moment. There's your opening bell. Switch at the board and get to the bond market. Yields look like this, higher by 9 basis points, breaking out again to 296.96 as some people start to think about maybe 2 Mondays ago that we hit the high on the 10-year for the year at 320. The market changes. I imagine the views might change too. Euro dollar positive 1 full percentage point, 105.34. A lot of calls out there about a stronger euro as the ECB has to do more and maybe the Fed has to back away. A lot of people, of course, on the other side of the trade as well. Crude 114.42 after having a little look at 115 earlier today. We're positive there by 0.25%. 30 seconds into the session, let's get you, your movers. Here's Abby.
Well, John, the stock bulls are certainly out on this Tuesday, and a big piece of it with that NASDAQ outperformance up about 2% has to do, not surprisingly, with big tech. One of the biggest winners on the day, biggest point boost for the indexes. Apple up 2.1%. Nothing fundamentally has changed, as you know, overnight, but it does seem to be a sentiment shift, even with yields higher. That's especially true for NVIDIA. Now, NVIDIA on Friday up 9.5%. Yesterday it fell. Now the chip maker is back up 0.4%. 4.9%. So some folks want back in on these big tech plays, these high beta names. That's true, too, for Tesla, up 3.5%. But, of course, as you know, Wedbush and Dan Ives reiterating their bullish stance as odds increase that Elon Musk's takeover of Twitter won't happen. Speaking of Twitter, now down an 8th day in a row, down 1.3%, down more than 25% over those 8 days, well below where the stock was when Elon Musk initially stepped in. Now the bid on hold. And Elon Musk, of course, as you know, John, wants proof that bots are 5% or less of the users. Investors seem to be betting that's going to be a tough thing to prove, John.
37 on the stock. Abby, thank you. 37 against an agreed price of 54.20. The spread is getting wider and not tighter. We'll talk about that with Dan Ives of Wedbush in just a moment. If you're looking at Chinese tech, those stocks are doing nicely too. JPMorgan recommending investors look past the near-term volatility.
The long-term perspective of the region in general and the China in particular, I think nobody has any doubts about that. Therefore, we try to stay away from short-termism and focus on we're doing this for the next 25 years.
Let's get to Ed Ludlow on the West Coast. Morning, Ed.
Yeah, good morning, Jonathan. US-listed shares of Chinese tech codes are much higher, actually, on this Tuesday morning. China's main political advisory body, the CCPPC, is, according to local media reports, holding meetings, a symposium they're calling it, with leaders from big tech. And the idea here is that we are getting signals that this year-long regulatory crackdown that Beijing has been enforcing on all corners of its technology sector could be easing, in part, of course, because of the economic pain in that country. This is a fantastic chart on the Bloomberg terminal. The NASDAQ Golden Dragon China Index, a basket of US-listed Chinese shares, has really trailed the S&P 500, the NASDAQ 100. It's an index down 30% year to date. But you look at the 12-month price target, the average analyst 12-month price target, there's a lot of potential upside here. And this is what we're betting on, that we will see an easing of this crackdown. And you come back to the economy, right? And JPMorgan going only 2 weeks ago from saying that this is a sector and a corner of the market that is, quote, uninvestable, to saying that we may see things ease. Why? Because they may have little choice, right? We're at a point where industrial output and consumer spending in this country, because of the zero COVID policy, are at really, really low levels, basically the worst since the pandemic began. Now, where do we go from here? Potentially some upside. Things in Shanghai are improving, but you look on the Bloomberg terminal and the reporting overnight about other Chinese cities, for example, Tianjin, they're not dealing with Omicron well. So is it a trade-off, John? It seems like it is.
I'm always skeptical about how transparent and open the South side is being about what they actually think is going to happen in China for political reasons. And Ed, we can touch on that another day. Ed, we'll talk about Twitter later this morning as well. I'm looking forward to catching up with you. But just a quick comment. We're down for an 8th day. To Abigail's point, that's the longest losing streak going back to 2021. Yes. We're down 26% in 8 days, Ed.
Yeah, I think we'll talk about the spread a little bit later, right? The spread between the offer price of $54.20 and where we trade now. But just think of it in simple terms. It's a direction of travel. 8 consecutive negative days, a lot of negative headlines, and a lot of doubt that this deal is actually going to happen. And if it does happen, then he might come back in for a lower price. And I think that is where we're trying to focus our attentions right now, John.
As you and I talk, the stock turns positive, up a third of 1%. Ed, we'll catch up with you in just a moment. 37.50, let's call it, against the agreed price of 54.20. That conversation coming up with Dan Ives in just a moment. Here in the US, the latest 13F filing showing hedge funds ditching big tech and piling into energy. Bloomberg's Shonali Basak has more. Morning, Shonali.
Good morning, John. It's not just technology that's being sold by the biggest hedge funds and other institutional investors. You're also seeing a slight sell-off in consumer, discretionary, and communications sectors as well. But when you look at the data here, there's a big dispersion between what the hedge funds are buying and what everybody else is buying. Of course, the hedge funds were already so overweight in technology. They are buying energy, though, now in bigger form than the average investor. Let's take a look at what's the most sold stocks, because interestingly, you see it show up in Berkshire Hathaway. Some of the most sold stocks include Bank of America, Vale, Occidental, Citigroup, and of course, Twitter. I know everybody is talking about as well. Activision Blizzard, HP, and Meta. But if you look at Berkshire Hathaway, they're doing some of the opposite. They're buying Citigroup, which, as we know, is much cheaper than a bank like Bank of America and Wells Fargo. They've bought Occidental, and so you're seeing some contrarian bets being taken even among some of the biggest investors. I also want to take a look at what the tiger cubs are doing, because we know some of the most famous tiger cubs have lost a lot of money, not just in the first quarter where these filings are reported, but also through April. Carvana is something that Tiger Global, Chase Coleman's firm, had a lot of. That declined even more. Rivian is something that Dan Sundheim is still holding on to at D1. And we see Carvana, some buying as well. You see Maverick buying more Carvana in that time frame as the struggling firm continues to work to raise capital.
Brutal for that name. Yes. Let's just put it that way. Shanali, great work as always. Our Wall Street correspondent leading the way on the 13F filings. This morning on the earnings, two very different pictures coming from two companies, Home Depot, Walmart. Home Depot boosting the outlook, Walmart cutting its profit forecast amid rising costs, and the CEO saying the following: inflation levels, particularly in food and fuel, created more pressure on margin mix and operating costs than we expected. Katie Lyons back with more. Hey, Kaylee.
Hey, John. Well, it's a tale of two retailers, and let's start with the one that brought good news, and that would be Home Depot, basically showing that demand is still strong in the home improvement sector, even in the face of higher mortgage rates. That showed up in comp sales that rose 2.2%. Analysts were expecting a 2.4% decline, so you got a surprise increase in revenue in the first quarter, plus, again, that outlook boost that you mentioned. For Walmart, though, of course, it was an outlook cut, and really the reason why the company has a cost problem, John. That is why the stock is down about 8.5%. They're dealing with higher costs when it comes to the supply chain and its labor force. Plus, as you alluded to, the CEO saying that high inflation in food and fuel is having an impact on the margin mix. Basically, consumers are having to pay up for basic necessities like food and gas, and that means they're spending less on other areas. And that's bad news for Walmart because a lot of the higher margin area is general merchandise, not groceries. And again, because they cater to a lower end consumer, they're turned to as a discount retailer that has lower prices than everybody else. So that, to a certain extent, caps the ability of Walmart to exercise pricing power because they want to maintain a price advantage relative to their competitors. And really what Walmart experienced is emblematic of the broader dynamic between staples and discretionary spending. Staples far outperforming discretionary on a year-to-date basis. Discretionary, the worst performer in the S&P this year, down about 28%, John.
Kelly, thank you. Kelly Lyons. BlackRock's Gargi Chaudhuri joins us now. Gargi, been looking forward to catching up with you all morning. When we last caught up, you had doubts about the Fed's ability to follow through on interest rate hikes. Given what we're hearing, what we're seeing, do you still carry those doubts?
So, good morning. Good to be here, Jonathan. I'll say a few things. Since the last time we've been here, one of the things that we heard from the Fed, from Chair Powell, that he did so well, I think, was that in the last FOMC meeting, he really aggressively pushed back on the market pricing of that 75 basis point rate hike and gave us very clear guidance that the next couple, meaning two meetings, are probably going to be 50 basis points. And, you know, that kind of stability is exactly what the market needed. I think even later today, when we hear from Chair Powell, I think we're going to hear along the same lines that, you know, they're not going to allow the Fed pricing to get too aggressive. You know, as long as we're pricing for a little bit above neutral, which is where we are, about 2.75 on the Fed funds by the end of the year, I think that's fine. You know, anyone that's in the camp that we're going to go to a 4% Fed funds just in order to get inflation back to 2%, I just don't see how that's going to happen given how much of the inflation is supply related.
So, Gargi, what do you think happens here? Just in terms of the market call, you think yields have peaked in the Treasury market? You think we've bottomed in the equity market? What are you looking for?
Yeah, so I think that, you know, we have to separate the front end of the curve and the longer end of the curve. We still haven't started the quantitative tightening process yet, and that's going to start in June. So I think the longer end, so think 10 years and higher, I think can still move somewhat higher. I think, you know, we saw about a 320 or so earlier this year. I think we can get there or a little bit above that as well. So no, yields haven't peaked in the longer end of the curve. And I think the front end, when you look at sort of the 2-year part of the curve, the 3-year part of the curve, I think it's getting fair here. I mean, it's not cheap anymore to the way that it was, but it's getting fair to, you know, I still think that you're supposed to sort of start adding to front end high quality paper here. I think there is an alternative as far as earning some yield, earning some carry in front end high quality credit like IGSB.
Gargi, can you give us some insight, just shine a light on some of the client flows? What you saw take place maybe in the growth scares of 11, 15, 18, what you've seen this time? Outflows, for instance, and what you're seeing in the flows now?
Absolutely. Absolutely. So a few trends that I'd love to highlight. The first one is just around inflows into shorter dated inflation protection. That is something that started in the beginning of 2021 and that continues. So people really flocking to sort of the 0 to 5 year part of the inflation curve. And that's something that we have been talking about and we've been seeing inflows as well. The reporter that was on right before me was talking about the 13F, obviously, and the movement away from technology. And when we look at the sector flows in ETFs, obviously there's been an outflow away from technology, and there's been this inflow towards more defensives, I would say. So there's been an inflow into minimum volatility, there's been an inflow into quality, there's been an inflow into healthcare. So that defensiveness is definitely something that's coming through very clearly. And then the last thing that I would say is that there has been pretty significant flows recently into the front end of the market, the front end of treasuries, and more recently into front end munis as yields move up pretty nicely.
Gargi, the reason I ask this is because a lot of people are using this word capitulation. They're looking for signs of so-called capitulation. What would you give you an indicator that that was happening? What would give you that indication?
If the signs of capitulation would be if we really saw broad-based outflows from the equity markets and moving into cash or moving into long-end duration, sort of just leaving the market because they're really scared about the investment horizon for the next couple of months. And we're not really seeing that yet. I mean, if we just look at the data today, the consumer is still in a very strong footing. Obviously, the retail sales number shows that. Then we have the IP number. Again, no fears here of a recession, yes. So that capitulation flows away from equities altogether. We haven't seen that. But the flows are reflecting a little bit of defensiveness, which I think makes a little bit of sense. If you are indeed worried about some sort of global growth slowdown, I think gravitating towards the more defensive parts of the market, towards quality, towards minimum volatility, and towards perhaps the front end of higher quality credit and higher quality treasuries makes some sense.
Gargi, thank you. As always, Gargi Chaudhuri there of BlackRock. Your equity market positive, 1.4% on the S&P, on the Nasdaq by 2.4 percentage points, about 13 minutes into the session. Coming up, Elon Musk casting more uncertainty over his takeover deal for Twitter.
I think Twitter is currently the best, or looked at another way, the least bad public square. In order to be better at that, it needs to really get rid of the bots and the scams and spammers.
And he keeps building on that line. More next with Dan Ives of Wedbush.
I think Twitter is currently the best, or looked at another way, the least bad public square. In order to be better at that, it needs to really get rid of the bots and the scams and spammers.
That was a week ago. Elon Musk, and in many ways, not much has changed in the last week. Twitter had this to say this morning. Twitter is committed to completing the transaction on the agreed price and terms as promptly as practicable. Joining us now is San Francisco is Ed Ludlow, back for more. Ed, the latest from Elon Musk on Twitter overnight.
Yeah, the latest from Elon Musk is simply that the deal will not proceed for $44 billion until he gets further evidence that satisfies him that Twitter's claim that less than 5% of users on the platform are bots is proven. He wants more data, essentially. And he was speaking Monday at this conference in Miami where he said, in his estimation, around 20% of accounts were fake or bots, and it could even be as high as 90%. He then followed up with the tweet that you see on your screen. And what he's referring to in the second part of that tweet, Twitter's CEO publicly refused to show proof of the less than 5% figure, is a very long Twitter thread that Parag Agrawal posted explaining the science behind, the methodology behind how they calculate it, how it's a mix of public and private data. But the most revealing part was that a week ago, according to Twitter's CEO, Parag Agrawal, he'd met with Elon Musk to go through all of this. If you come into my Bloomberg terminal, the upshot of all of this is that the market increasingly doubts whether this deal will happen, right? That's the spread between the $54.20 offer price and where we're currently trading. We're down for an 8th straight day, John, as you know. Where do we go from here?
We'll ask someone else. Ed Ludlow, thank you. I'm going to ask Dan Ives of Wedbush, who says this. This circus now takes another turn as Musk appears to be walking from his deal or driving a much lower price on the spam fiasco. For Twitter, the street will now assign a high probability a deal does not happen. Dan Ives joined us right now. Dan, you and the team over at Wedbush say 60% chance that Musk walks away from Twitter. Why isn't it higher than that?
I mean, it could be higher. I mean, it could be as high as 70, 75%. I think what Ed's talking about, if a deal does get done, it's significantly lower than the 54.20. I mean, 54.20 at this point, it's out the window. There's a better chance for me playing for the Celtics in the playoffs, and that deal happened at that price. Now it just comes down to, can they renegotiate on the bot issue, or does he walk? And of course, if he walks, you know, it's not as simple as just the $1 billion breakup fee. I think there's also a lot of issues that could play out in court that the Twitter board would contend as well.
Oh, so Dan, talk to me about that. What do you think those issues would be?
I think if you look at the actual specifics of the deal, some of the actual due diligence, I think there's questions about if he could actually walk on this specific issue. And that's why right now, I mean, Twitter board, they're between a rock and a hard place because there is a deal that's agreed upon. Obviously, the market has dramatically changed. We continue to believe Musk got cold feet. It is more of a scapegoat issue. No doubt the bot issue is clear and present. That's a known issue. But the fact that he's trying to contend it, I mean, the New York City cab driver knew that Twitter had a bot issue.
Dan,
and I think that's
wait a
the
second,
frustration.
though. Just help me understand this a little bit more. Why can't he just walk away, pay the $1 billion, and that's it?
Well, I mean, I think there's some specific due diligence that he ultimately would need to prove, right? That about the 5% being inaccurate versus what he's talking about. And that specific issue needs to play out right now behind closed doors in terms of them either renegotiating, coming to a number, coming to what ultimately would be a lower deal price. And that's why the street right now is assigning Musk. He's getting cold feet looking this is a scapegoat to try to get out of the deal. If he does do a deal, it's obviously at a much lower price. And that's why right now that street is basically waiting to see how the negotiations go behind the scenes.
Well, no one is seeing this play out behind closed doors. We're seeing it play out in public, one. And two, if a higher price is on the table, Twitter's in play, Dan, for more than just Elon Musk. Who else is lining up, circling around this name?
I think that's the fundamental problem because they'll be at the altar with no one there. Because at these prices, I don't think there's a strategic or a financial that's interested. I think you start to get to lower prices, then you could start to, ultimately see some bidders come up. But that's why right now, Musk, I still believe there is some chance he wants to get the deal done at a lower price. But the problem is that I just don't see any other strategic or financial bidders out there, which is why Twitter's back's against the wall in terms of how they handle this, what I'll call Alfred Hitchcock-like episode.
Dan, good news for Tesla.
Yeah, I mean, this has been over an $100 per share overhang on Tesla stock. Big part of it is that leverage. That $300 billion's come off of Tesla in terms of Musk's golden child. And I think ultimately that was really where the rubber met the road. I think that's what really changed the mind. He underestimated, I think, the impact on Tesla stock. This would be a bit of a relief. But let's just be clear. The way Musk has handled this is a disaster. It's a black eye for Musk. And I think in the eyes of the street, I think there's actually a net negative impact, even in terms of for Tesla stock, just the way Musk has handled this.
Dan, I've got 20 seconds. What are you still doing at 1,400 on Tesla when we're at 750 right now?
I mean, look, for us, it's all basically about what units look like this, over the next month or two, how bad that China number is going to be. And then ultimately, if we feel like there's a change in the fundamental thesis, we would change our numbers and price our equivalent. But as of now, we have not done that in terms of what I continue to view as just a massive risk off across the board. As me and you've talked about, I do believe it's an overcorrection across disruptive tech.
We'll keep talking about it. Dan, it's good to catch up, buddy. As always, Dan Ives of Wedbush. He's staying bullish. 1,400 price target on Tesla right now, 749. Your trading diary up next. 26 minutes in, holding on to the gains. Equities up on the S&P, on the Nasdaq too. Let's get to your trading diary. President Biden, 1 p.m. Eastern time. Fed speak with Chairman Powell, 2 p.m. Eastern. Retail sales target on Wednesday, followed by U.S. housing starts and another round of jobless claims coming up on Thursday morning. That's the week ahead from New York. Thank you for choosing Bloomberg. This was the countdown to the open. This is Bloomberg TV.